Welcome back. Before we take a look at today's business news, let's take a look at the stock indices across the GCC. And in our top business story, Dubai's non-oil foreign trade crossed the 1 trillion dirham barrier during the first 9 months in 2013, compared to 918 billion dirhams in the same period in 2012. Dubai Customs statistics showed that Dubai's imports reached 610 billion dirhams, compared to 546 billion dirhams in the year earlier period, with exports and re-exports rising to 399 billion dirhams from 372 billion dirhams. According to local reports, His Highness Sheikh Hamdan bin Mohammed bin Rashid Al Maktoum, Crown Prince of Dubai and Chairman of the Dubai Executive Council, was quoted as saying that the Dubai's trade sector will undoubtedly witness tremendous growth over the coming few years, following the announcement that the Emirate will host the Expo 2020, adding that trade is one of the key pillars in the overall structure of our local economy and a main driver for its growth. We look at the rising curve in trade volumes as an indicator of the success of our developmental strategies. India ranked first among Dubai's total non-oil foreign trade partners, as trade volumes reached 111 billion dirhams, followed by China with 99 billion dirhams and the US with 65 billion dirhams. Gold represented the largest share of Dubai's imports, followed by cellular and wired communication devices, then diamond, cars and jewellery. As for exports, gold came first, followed by raw aluminium, then petroleum oils, jewellery, cigars, cigarettes and tobacco alternatives. Gulf Air on Sunday launched its first flight to Al Maktoum International Airport at Dubai World Central, making Bahrain's national carrier the first full-service carrier to commence operations to Dubai's new airport. The carrier said in a statement that the new service is in addition to its current operation of 51 flights per week into Dubai International. It added that its new daily evening service will attract those travellers looking at DWC's proximity to New Dubai. The US dollar came under sustained pressure last week as a host of economic data improved market sentiment about the US recovery. With the improving data flow from the US, market participants are expecting a taper as early as December 17 to 18, when the Federal Open Market Committee next convened to announce rates and a potential taper. To find out more about this, we earlier spoke with Gaurav Kashyap, the head of futures at Al Pari Middle East, to get his views on the upcoming week of trading.
Well, the US dollar is open this week on the back foot once again. Now, we've entered probably the 5th or 6th day where the US dollar has remained under siege against higher yielding assets, including currencies, as well as equity markets. But I think it's quite premature to say that we've seen the start of a bearish US dollar move. Basically, what we saw on Friday was a much stronger than expected US non-farm payroll report. Once again, it was the second consecutive month in which the US economy chalked up more than 200,000 jobs. But more importantly, from that report, we saw the unemployment rate dropping to 7%, which was particularly exciting considering the increases that we saw in the overall labor participation rate. Now remember, the last couple of non-farm reports, we saw decreasing unemployment rates, but that was amidst a shrinking labor force. But in this most recent report, we saw drops in the unemployment rate amidst an increasing labor participation rate. So that's very good news there. But strangely, looking at the reaction to the markets, the knee-jerk reaction was to be very dollar positive, but it looks like the markets digested the news, and that improved sentiment drove markets higher, taking equities also higher. Overall, markets will remain volatile in the lead up to the FOMC meeting. Remember, they do meet on December 17th and 18th, with many in the markets expecting a taper anywhere from 5 billion to 10 billion announced in December. And this should continue to weigh down overall sentiment, so trading will remain volatile. Overall, also, we are looking at the Chinese economic calendar. We had inflation reports coming out earlier this morning, which showed that inflation had drawn down slightly to 3% out of China. Also coming up from the Chinese calendar will be the manufacturing and industrial production figures later in the week. But overall, we expect the US dollar to remain on the back foot trading conditions will remain volatile. We can expect gold to range between 1180 and 1250 in the week ahead. The British pound looks good to test 165 levels against the US dollar, with the euro also probably making a run towards 138 in the week ahead.